Nirav Seth, CEO Institutional Equities at Emkay, is here with us. Nirav, afternoon. Thank you so much for your time. So you have a set 24,000 Nifty target for the full year. Do you think there's a case to revise it upwards, given the way markets are taking shape now? We are all 700-800 points away from that level.
Target, obviously, Sen, who is at a head of research, is a strategist and he runs the model portfolio. And I assume that, I can't speak on his behalf, but this is obviously a moving target. We need to look forward to, the next big critical event is budget. And I believe that that will set the tone for what India needs to do for the next 5-10 years. And I believe that you are likely to see a reasonable level of indirect reforms. Please appreciate that we've very successfully enacted the direct reforms. And I believe that it's time for us to try and now take the revenue neutral rate of GST down and set that vicious circle of lower prices and higher growth rate and therefore still lower prices. And when you start incorporating those incremental data points, I'm assuming that, you probably have more upsides in terms of actual targets on the Nifty.
Hi, this is Anish also joining in the conversation. So yes, policy continuity is there, but if I had to ask you what's the best tactical trade right now given the context, what comes to mind?
I think both from a tactical basis and a structural basis, I would like to believe that you need to be invested in the markets. I am not a great believer of trying to time the markets. Please keep in mind that if you look at India and Indian markets on a 3-year basis, Indian markets have never delivered a negative return ever. And this is despite GFC crisis, this is despite the Fed taper, and this despite the pandemic. So that's the inherent strength of Indian economy, right? So you growing at about 7-8%, your earnings are compounding at about 13-14% right now. You are above the trend in terms of the earnings growth rate. On a 3-year perspective, on a 2-year perspective, I'll be very surprised if the Indian equity asset class probably remains the best investment opportunity.
Talk to us about how do you marry this entire hypothesis with valuations, because specifically some areas of the PSUs have really run up very sharply. Are you of the view that valuation has to be looked at in a different lens now in terms of what lies ahead for some of these pockets?
So I think usually when we say that you want to look at it from a different lens, it's a bit of a dangerous territory, and I'm completely on board with you that there are sectors where there are frothy valuations and stuff like that. But this is all a lot of the stuff that you do is many hindsight calculation, right? So the fundamental rule in equity market is if you got longevity of a business model and if the markets can perceive earnings growth for a longer period of time, you will see that bump up in valuations, which means that for new investors, the required rate of return has to be lower. To me, the one way to get away from this is to try and have a very diversified portfolio. And I think India offers that opportunity. The way to put it across is that if you actually look at the last decade, and I'm talking about 2010 to roughly 2020, 2021, a concentrated approach to portfolio worked very well because very few sectors were driving earnings. Now, when you look at the Indian economy, when you look at the breadth, the tail of the companies, and the breadth of the earnings distribution as well, I believe that you need to create a long tail of companies. So that reduces the risk. At the same point of time, it allows you to, rebalance the portfolio depending on the stocks go up or down. But it's not easy to make money at the end of the day. So just because the things are good and you want it cheaper, life is not that easy.
Yeah, you can't get growth as well as cheap valuations at the same time, right? It's too much to ask for. But then, where would you recommend to invest incrementally? People who have to deploy right now. Yes, having a diversified portfolio is good, but which sectors to go towards and where to book profit out of?
So I believe that this is largely what has happened in the last 10 years, right? So markets continuously rewarded a particular set of companies and particular set of ideologies, which is largely high ROC, high ROE, consumer-facing businesses, and which is where the capital eventually went into. And the fact that your infrastructure was largely ignored. almost everyone in the world is today short energy, right? So someone has to set up utilities, someone will have to set up transformers. So the prices have to be higher to incentivize those kind of investments, and that is what is happening. So I believe that when you look at the energy transition, it's a big investment opportunity. And when you look at electrification, I believe that a large part of the Modi 3 agenda would be to try and ensure that we don't lose out on this the ecosystem supply chain for electrification in the country. And we'll see more policy moves. They only talked about allowing the cars to be imported at lower duties and stuff like that. EPC companies, real estate, PLI templates. I also believe that I briefly touched upon the fact that you will have indirect reforms, which means that a lot of the consumption stocks will benefit as well. The discretionary part, the autos, the two-wheelers. Despite the fact that valuations could be challenging, and of course banks, because you still have value in banks and including NBFCs.
All right, so Nirav, we'll let you go on that one. Thanks so much for joining us on the show.
If you like this video, then like, share and subscribe to ET Now.